Alright guys, welcome back. I'm really excited today to bring to you this one healthcare growth stock that I'm buying as part of a series of videos that I want to make in the upcoming months for the duration of 2020. And today we're going to be talking all about healthcare stocks, but more specifically this healthcare growth stock. So on the agenda, I've got a few key items that I wanted to cover with you. We're going to start off by talking about the US healthcare system. And we're going to talk about some background and context into that and why this then necessitates the need for good quality healthcare stocks. Then we're going to talk about the health savings account, which is directly related to the stock that I'm going to talk about and present today, and the use case for HSAs and why they will, I believe, continue to grow and even eclipse some of the more popular other retirement accounts available in the USA. Then I'm going to talk to you guys about what the stock is. We're going to talk about why the stock is down and why I think it'll go back up. We're going to talk about the valuation, my average buy price, my target price, short, medium, and long term, and then we're going to conclude with the risks. And I know some of you guys are saying, oh, look, why don't you just get straight to the stock? Okay, guys, if you want, you can skip forward sort of 5-6 minutes and get straight to the stock. But if we don't go through the background and context first and the use case for HSAs, then it's not going to make any sense, all right? And hence that's why I wanted to really share that with you before I tell you what the stock is. And as always, guys, if you're getting value from my content, you're learning something, and you're finding really cool stocks through my research, make sure you smash that like and subscribe button because it helps me bring more research like this for you, and also because it's good karma. All right, guys, so let's get into it. Now, the healthcare system of the USA, if somebody was to ask me to describe the healthcare system of the USA in one word, the only word that will come to mind is terrible. It is an absolute shambles, and it's just getting worse and worse. And the reason being is because healthcare costs have grown so fast that, you know, I think they're getting to the point of ridiculousness, because the growth of healthcare is far outpacing the growth of real wages of your average worker. Okay, I'm not talking about the rich, I'm talking about the average worker, 98% of the population in the USA, right? Healthcare expenses are outpacing real wage growth. Or looking at it in another chart, you know, the average family, you're looking at being out of pocket about $20,000 a year for you know, premiums for health insurance, right? And then if you're a single person, we're talking at least $6-7 grand a year. Now, keeping in mind, okay, that these premiums you have to pay no matter what, and if you have a healthcare problem, okay, whether it be minor or major, you can still be out of pocket for up to $6,115 for the year on top of the already exorbitant premiums that you have paid. And this is, you know, and most people just don't have that kind of money saved up in the US, right? I mean, if you look at it, the majority of people, right, 2632, that's almost 60%. 60% of people, they've got less than $4,000 saved up, and the majority have about $1,000. And so this has caused a problem whereby American people are just simply avoiding going to get medical care, right? Seeking treatment, seeking things that they might necessarily need, but they just either can't afford it or don't want to because, you know, their hard-earned money, they want to spend it on other things, right? So this is the problem. And so here's the use case for the health savings account, right? And so this has necessitated the need for a health savings account. But the thing is, people are only just starting to wake up to the benefits of a health saving account, because traditionally, people would only look at a couple of things for retirement, right? They look at the IRA account, or they look at the 401k account. But nobody, or not many people, have woken up to the fact that the health savings account could be an even better option for the majority of people to help save for their retirement. So, simply put, the health savings account, it has very similar benefits to the 401k in terms of, you know, you can take your money, you can invest it in a diverse set of equities, etc., right? Withdrawal, tax-free when you retire, etc. But there are a few key benefits that none of the other accounts have, and that is the triple tax benefit, okay? So all of your contributions and your deductions are tax-free, and you can voluntarily contribute more up to a certain threshold tax-free, all right? The withdrawals for all qualified medical expenses, these will be tax-free, and then you can offset that from your gross income. All right, guys, and that is absolutely huge considering just how expensive healthcare is in the USA, and you don't get that benefit with any of the other retirement accounts. Okay, and then finally, your employer contributions will also be tax-free, and like all the other retirement accounts, right? You retire at the age of 65, and then you can start using the money. But the benefit is that it's the triple tax benefit. Contributions, employer contributions, and then medical expenses, fully tax-free. That's huge. None of the other accounts have that, all right? Now, the other benefit of a health savings account is your health insurance premiums are actually far less than that if you don't have a health savings account. And so on average, again, considering people don't have that much money or make that much in the States, they are saving they're saving an average of under $3,000 almost on their premiums a year, and the employers like that as well because they are saving money and they're getting tax rebates through their contributions. All right, so this is the use case for the health savings account, and so as a result, you guys can see here people are starting to wake up to this, and they're going, oh damn, like healthcare is this expensive, and I can just use this. I mean, if I don't seek medical treatment that often, then I can potentially just use this as my retirement account. And so as a result, what you've seen is an absolutely exponential growth of health savings accounts, number of accounts and assets, especially in the last few years. Okay, so 37% of accounts were opened by people in the last 3 years because they're finally starting to wake up, right? They've been asleep at the wheel in the HSA, and now they've realized that it's a great alternative or even a better option. Furthermore, if you have a look at the assets, again, they were growing ever so slightly, and they weren't that big back 10, 15, 20 years ago, right? But looking at it today, last year they grew 24%, and it's forecasted that they will continue to grow because, again, people are starting to realize that they will have the same benefits, and they can still invest, get good returns, it's all tax-free in a health savings account, okay? And so if we focus on that, it's estimated that the industry will grow 25-27%. So there are already massive tailwinds in terms of the awareness of health savings accounts and people switching over and then putting more of their money in here. The other thing is the increasing awareness among people. It's actually the more younger, I would say, people like our age. We're talking millennials, right, between 20, 30, late 30s and even early 40s. They're also starting to realize that if they don't get sick that often, then they can save a lot more by using the HSA as their retirement account rather than the IRA and 401k. Having said all of that, now I wanted to tell you about the company, which is a company called Health Equity. All right, guys? And I think it's a fantastically run company with some great tailwinds going for them. And you guys might be saying, well, look, why would somebody outsource and then pay extra monies to somebody like this to do the administration of the services, right, for the HSA, right? Why can't the HR department do it? And to that I say, guys, talk to anybody who works in HR and ask them how difficult it'll be not just to administer benefits for HSAs, but you've got your flexible savings accounts, health retirement accounts, commuter accounts, COBRA accounts, and other client-designated benefit accounts, okay? It's an absolute nightmare, and this is exactly why companies don't want to do it, because of the complexity of America's healthcare system. They'd rather pay somebody who knows how to do it well and can do it en masse. And as a result, if you look at Health Equity's growth of their accounts, their members, their active HSAs, right, their assets, you can see that it's growing very, very rapidly. In fact, it's outpacing the growth of the market in terms of the and despite the growth of the market, it's already huge, right? 20-something% plus growth in terms of assets and accounts. That's huge. And Health Equity are managing to outpace them, right? So they are growing 29% versus 23-24%, and they already have billions and billions of dollars in terms of assets and cash, right? Following the WageWorks acquisition about a year and a half ago, it actually took their business from the sort of number 2-3 player into the number 1 player, all right, guys? And so what they're doing is they're expanding their network, and they're also expanding their ability to cross-sell because they've effectively acquired, I would say, maybe the number 3 player at the time. So now they have about 20% market share of the entire US benefits administration market. They're growing their market share both organically and non-organically, because without the acquisition they grew 29%, with the acquisition they grew 49%. So it really shows that management are able to grow their business organically. There's good demand, and then upon acquisition that's going to then accelerate the demand. And the reason why that's good for Health Equity is because they've got 3 key service revenue streams. So they get revenue streams from administration services, they get revenue streams for holding the people's cash and then getting a good return on deposits for it, but then they also get interchange revenue, which effectively is, customers paying for their medical expenses, right? Now, Health Equity actually issue their own debit cards. So this is good for them because every time somebody spends, they're able to clip the ticket. All right, guys, so now what we're going to do is we're going to cover the 3 key times that the stock was sold off and why I think that the sell-off is unjustified. And once there's a couple of good catalysts, which there will, believe you me, right? Then the company is just going to bounce back to the highs where it traded from. Okay, guys? So let's have a look at the first sell-off back in November, December 2018, all right? This was simply a fact of the market getting ahead of itself. The stock was priced to perfection, and everybody's expectations were too high. Management were delivering on their promise, but the market was expecting too much, so that was self-inflicted, right? So really, that's not a good reason to sell things off. Furthermore, back then, we had the whole US-China trade war, which then exacerbated any premium or richly valued growth stocks, right? So that further exacerbated the decline. The second reason why they got sold off was because, like I mentioned before, they had acquired a company called WageWorks, and back in August in 2019, WageWorks had badly missed their numbers, okay? They had badly missed their numbers, and the market was going, oh, this is a disaster. Health Equity acquired a piece of crap and sold it off. However, as we saw shortly after, in December and February of this year, Health Equity brought the business on board and started fixing all of the problems, and so all of the cockroaches, under the fridge, skeletons in the closet, they successfully got rid of that. And so as a result, the following quarter there was a massive beat and the stock rallied heavily. In further testament to the company fixing the business and turning the WageWorks business around, they even increased their guidance as early as February this year to show that really, the whole sell-off about the WageWorks missing and having problems, right? This was a bit of a nothing burger. All right, guys, so now let's talk about the most recent sell-off, okay? We're talking back in March. And this one, it had a lot to do with the whole sort of, lockdown, virus, pandemic situation, right? Because what happened was, as you guys know, a part of their business model, Health Equity gains interest from taking the funds of the HSA account owners and then putting that into a CD account, getting interest revenue, okay? And what happened was, again, the stock got priced too richly at all-time highs, and then they downgraded their guidance by a mere 4%, because interest rates have absolutely tanked into oblivion, all right? And so what happened was the market pretty much sold the stock off 50-something percent, 60% plus. The reason why that is an overreaction is because 23% of their revenue is to do with interest rates, which means that the rest of it, right? The other 77% has nothing to do with interest rates and the fluctuation of interest rates. Furthermore, their fastest growing portion of their business is actually the service and administration revenue. So that's a massive overreaction on the market. And not only that, but the situation of low interest rates. They've been there before, right? Back in 2015, this was the absolute lowest their company ever had on interest rates. Their interest rate returns when the CD rates were that low, it was about 1.5 odd percent. All right, guys? So again, a massive overreaction because their maximum exposure, as you can see over here, because they're currently getting about 2.2%, it's not actually that big, okay? And furthermore, their competitors are going to struggle a lot more than they actually are, because 23% of their revenue comes from the yields on custodial cash, but then industry-wide, the comparable figure is 53%, okay? So this could actually even be good for their business, because as the smaller players start to buckle and fold, this could potentially allow them to pick up their assets on the cheap, much like what Oracle does during market crashes. Okay, guys, so keep that in mind. And furthermore, if you guys think about it, they had the situation before back in 2015, and this was the only time they ever missed. The market isn't really seeing the forest from the trees, because if you think about it, it works both ways, right? They have got debt that they have to pay interest on. So it's not just that they're going to get less interest on their deposits, but if you look at their debt, they've lost about $30 million in terms of the yield on their cash assets, but they're going to be paying $20 million less on interest. So really, we're only talking about a $10 million hit. Okay, so now let's talk about my buy price, my target price, short, medium, long term. Okay, so as you guys can see, I opened a position in Health Equity, 16th of April, 2,000 bucks. I want to build this position to about $6,000–7,000. Looking at the trading action and the price action, you can see that they're sort of stuck in this support resistance zone, and they're really waiting for some catalysts, okay, some good news. And based on my analysis, I believe that the catalyst will come within the next 1 to 3 earnings calls. Okay, guys, so we're talking within the next 3 to 9 months. They're going to report, and people are going to see that the interest rate issue really wasn't that big of a problem, and they'll be growing massively, you know, getting more assets, getting more accounts, getting more customers. So what's going to happen is, I think that upon the catalyst, they're going to fill the gap, and it's going to come back up to this zone over here, this sort of next resistance support zone in the short, medium term, 3 to 9 months. Target price, about $68, $69, $70, okay? That's my short-term target price. Now, long-term, I think that this company has a lot going for it, and I think that it has many of the similar qualities that automatic data processing have, okay? And keep in mind that this company, you know, IPO'd way back in God knows when, like the 1970s or something, and they just grew and grew and grew. In fact, this was Peter Lynch's favorite stock, right? I believe Peter Lynch bought it back when it was $3 or something rather. And they have very, very many similarities, and they're really just creating this competitive economic moat where, you know, people who are happy, they don't really change administrators, okay? To change a payroll and a benefits administrator, it is an absolute nightmare. So unless they're doing a terrible job, most people are very sticky, all right? They process 1 in every 6 payrolls in the private sector in the United States alone, okay? Compare that to Health Equity. They are the benefit administrators of 1 in 7 working Americans. Now, I'm not going to ramble on about the risks, because if you guys want, just hop into their investors page, pull up the 10K report, and then you can see all the risks. But I think the key risk in this circumstance is that the interest rates will remain low and depressed for a long time, and as a result, it'll continue to hurt 23% of their business. Now, at a worst case scenario, let's say the interest rates remain at 0 for the next 10 years. We're still only talking about a maximum exposure of 23%, and that'll continue to get less and less, because as they continue to scale and leverage, operating leverage, and grow in terms of their accounts, their assets, etc., right? That's going to offset that. So again, guys, we're only looking at an exposure of 23% of their business, but also we need to keep in mind that their debts that they have to pay interest on, that's going to equally come down. So really, we're probably only looking at about a 10 to 15% exposure. People will say, oh, it's a competitive industry, etc., etc. Yeah, but everybody has the same problems, right? Everybody in the industry is competing with each other, and also Health Equity are the biggest, so they're far less likely to fold, being 23% exposed to interest rate variability rather than 50-something%. Alright guys, so that's the end of the video. I hope you enjoyed it and got some value out of it. As always, feel free to leave a comment. Let me know which healthcare growth stocks or healthcare stocks or growth stocks that you're looking at. And until next time, happy investing. I'll catch you in the next video.